Let's go. All right. Okay. So welcome back, fail-safe investors. Welcome to my channel. If you're new to my channel, my name's Terry, Fail-Safe Wealth, where I kind of give you tips and a little bit of financial advice on how to build wealth through like stocks. Eventually, I'll open up my page to other avenues like real estate and things like that. But since a lot of people are new to investing, and a lot of people want to learn how to invest in these times, since the stock market took a huge dip in March, I decided I'm gonna go all in on stocks right now and pretty much try to build up people knowledge on the stock market and understand all these things. So originally, this video was going to be dedicated to like building a dividend portfolio, or like a solid portfolio consisting of dividends, or you can pretty much say value companies that's been through recessions, have raised their dividends through recessions. And I was going to give you like a couple companies as a recommendation to invest in if you didn't already have any. And I was going to pretty much walk you through how to analyze a dividend company, because it is a lot of things you got to take into factor when you're analyzing a dividend stock versus a growth stock and all these other things. So as I was doing my research and looking up into these dividend companies, there were a couple things that I've noticed about these companies that kind of like raised some red flags. And as I started to notice these things, I kind of remember that a lot of people that's on my channel are pretty much new to investing and they don't know these things. So I pretty much made this video instead of the original video I was going to make. Now we'll have a video coming after this eventually on like the recommendation for the dividend portfolio and dividend stocks and all of that stuff. But I'm going to dedicate this video to like understanding dividend stocks, everything that you need to know about dividend stocks, the red flags, and then I have two examples of bad companies, that pay a dividend, and things that you want to look out for when you're looking into dividend stocks. So a couple things that you need to understand about dividend stocks is, yes, a dividend is pretty much a payment to you as the investor for holding on to these shares of the company or investing in this company, we should say, because pretty much that payment comes from profits. So what a lot of people don't understand about dividends is, one term that you need to know about dividends is what's called a ex-dividend date. And another thing is a pay date, but a pay date is pretty much self-explanatory. So all of those things get listed when you're looking into these companies. You can pretty much Google those and pretty much find out when the ex-dividend date is and the pay date. But for the people that don't know what an ex-dividend date is, and the ex-dividend date is pretty much they're gonna base your payout off of the amount of shares that you have by that date that is on that ex-dividend date. So let's say if you have $10,000 worth of shares of company A by the ex-dividend date of June 3rd or whatever, by June 3rd, they're gonna pretty much base your payout on that date. Now that doesn't mean that the pay date is on the ex-dividend date. It's usually like a month afterward or something like that, or sometimes 2 weeks, it depends. They can list their own date, but you want to know what the ex-dividend date is. But another thing that you need to know is the dividend yield. So the dividend yield is the percentage of the payout that you will receive personally. So if you have $10,000 worth of company, we'll say B in this example, if you have $10,000 worth of company B and the dividend yield is, let's say, 10%, then yes, you will receive $1,000. But this is what a lot of people don't understand about dividend payouts. How dividend payouts, since they pay out quarterly, you will receive $1,000, and it's all in the phrasing. Yes, you will get 10%, but you'll get that $1,000 paid out in quarters. So by the end of the year or annually, because the dividend yield is annually. So anytime you hit a term annually in the stock market, that's pretty much for the whole year. So 10% yearly, so pretty much what you'll get is $250 the first quarter, $250 the second quarter, $250 the third quarter, and $250 the fourth quarter to equal up to that $1,000 payment at the end of the year. So that's why it always pays to invest more into a company. But what a lot of people won't tell you is that you really want to look out and you really want to be careful with those companies with a high dividend yield. So pretty much you want to be within the 1% to like 3 to 4, and even 4 is kind of pushing it, because we're going to just use common sense here. These companies have to use the profits to pay out those dividends. So if you have a company that's paying out 10%, and most of these companies are, even though they are billion-dollar companies with hundreds of billion-dollar market caps, or sometimes billion-dollar market caps, or even like $100 million market cap, they might not make enough to pay out. So they don't usually have high. Anything that's like 9, 10%, or even 6 or 7% is considered high. So I did a stock analysis of the company AT&T. If you haven't already watched that video, I have the link in the corner over here. You can pretty much tap on that and go watch that video. And in that stock analysis, I mentioned how AT&T has a dividend payout ratio of 105%. So if you don't know what a payout ratio is, I want to say it's self-explanatory, but the simplest terms is how much percentage of the profits that they pay out in their dividend. So if AT&T has a payout ratio of 105%, that's 100% profits, and then 5% of what? So at the making of that video, I didn't really know how they pay out that extra percent. So it's pretty much self-explanatory. They either use cash, they sell stock, they go into debt sometimes, or these companies will sell off assets just to pay off that dividend. And that's why you really want to stay away from companies with a considerably high dividend yield. And like I said, anything like that's over 5 or 6 is usually considered high, but a payout ratio matters. Because if they had like a 6% dividend yield, but with the payout ratio of like 40%, then that's great. You know what I'm saying? Because now they have 60% to invest back into the company to bring even a bigger return back on my investment. So you definitely want to look at the payout ratio. That's probably like a big thing that you want to look at. And payout ratios are easy to find. Like I've mentioned before, I invest with Fidelity, and that's what I love about Fidelity. When you go on an actual computer and look at their home page, any ticker symbol that you type in, you just scroll down, and if they pay a dividend, they'll have a whole entire section cut out on the page just for that, and then you can automatically just look at it and see the payout ratio instantly. So just in case you was wondering, a good payout ratio would be anything that's like 50% or under. And it depends on who you are, what type of company you're looking at, and what you're willing to tolerate. But for me, it got to be like 50% or less. Depending on the company, I might let it go up to 60, maybe 65. But you got to be strict on these companies. It's kind of like being a parent, but that's just me. So that's another thing that you want to look out for. You want to look at the payout ratio, the ex-dividend date, the pay dates. You definitely want to understand that most of these dividends pay out quarterly, so that's every 3 months. And then some dividends pay out monthly, so you definitely want to look at that. And in the video that I was going to do about building a dividend portfolio, I was going to throw in like a high dividend yield, company, and then mix it in with some lower dividend yield companies to equal up to like a 10% maybe. That way, if you invest over time, then you can get back more and more. Now you have to understand that dividend yields change all the time. So when the stock market took a huge dive in March, about 80% of the companies in the stock market pretty much cut their dividend yield if they were paying a dividend yield. A lot of companies just said, look, we're done paying a dividend right now. We need to pretty much focus on restructuring our company, and everything has to go back into the company. So all the profits has to go back into the company. So remember that companies can cut their dividends at any time. And so that's why a certain list has been created called the Dividend Aristocrats. And I hate to use the air quotes, but Dividend Aristocrats. And what these aristocrats, how they got that title is they pretty much paid a dividend for more than 25 years. They've also raised their dividend year over year within those 25 years also. So that's how you kind of become a dividend aristocrat. Now, AT&T is a dividend aristocrat, but like I've mentioned, they pay 105%, of their profits, 105% in dividend. So that's just a couple things you want to remember when it comes to looking up dividends, and terms that you want to understand when it comes to dividends, and pretty much understand dividends. And then the two examples that I have are a company that you might know and a company that you might not know. The reason I picked these companies is because the one that you do know, you probably wouldn't expect this from a company like this, or you might look at it and say that's a good buy. And then the other company is a company that has a really high dividend yield, and someone might be attracted to that dividend yield. And that's why these companies have high dividend yields, to attract investors. But those companies that have high dividend yields are usually strapped for cash. They need cash. So they need investors. So they raise their dividend, and then that attracts investors. And then you pretty much left holding the bill after the pay date. I'm just gonna be honest. Or the ex-dividend date. One of the companies is British Petroleum. If you don't already know what British Petroleum is, ticker symbol BP. It's a $90 billion market cap company. They made like $270 billion in revenue last year, 2019. And then the other company that's a bad apple in the dividend world would be Riviera Resources Incorporated. And the reason why this is a example that I'm going to use is because this company, even though it's like $100-something million market cap, this would be considered a penny stock. Another thing, I don't want to get off track here. Penny stocks are anything that's in like the small cap. So anything that's under 9 billion market cap would be considered a penny stock no matter what the price of the share is. Just want to get that out there. This would be considered a penny stock. It's worth $1.80 a share, but the dividend yield is 163%. So they have it listed. They're paying $3 in dividends for $1.80 share. So that should freak you out. That should scare you. Now, buying stocks is kind of like gambling, but that risk to reward is just too risky. I would definitely not invest in Riviera Resources, even if the dividend yield was 163% and I can get $3 on $1.80. But first we'll take British Petroleum. So British Petroleum on the surface looks like a pretty good buy. They're selling for like $26 a share. They have a 90 billion market cap. So with a big market cap like that, the people that know like about investing would think like, okay, a 90 billion market cap, this company isn't going anywhere anytime soon. But listen to the video. So they have a 90 billion market cap. They have $270 billion in revenue. So they do have revenue, but they have negative earnings per share. So now I know a lot of oil companies and energy companies in the energy sector do operate with debt. And when you're a company of this size, you can operate with debt because you could just issue more like debt through bonds and raise capital like that, or sell off assets and things like that. But like I said, they have a dividend. So they pay a dividend. They don't have any earnings per share. So you don't have any profits. So then that begs the question, how are you paying a dividend? And then not only that, you have a dividend yield of 9.22%. So British Petroleum has a dividend of 9.22%. The payout ratio for British Petroleum is negative 260%. So they're pretty much taking either from their revenue, they're probably issuing or selling more stock or using the money from their stock, or they're issuing more debt through bonds, which I'm pretty sure they issued a lot of bonds in the last 3 months, or they're selling off assets to pay off a dividend, just to pay a dividend. There is no requirement by law to have a dividend. So they could have cut their dividend and then just use all that money to pretty much build the company or pretty much keep the company afloat, but they didn't. They have a 9.22% dividend yield, negative 260% payout ratio. I would definitely stay away from a company like this, even though they do have revenue. They're in a sector that is dying. So a lot of consumers are kind of weeding themselves off of petroleum. You know what I'm saying? I'm just being honest. So you have to understand the market that you're investing in also. And that's why I always say do your research, understand the company that you're investing in and all of that. You have to understand these things. So a lot of companies are weeding off of petroleum now. Companies like the oil sector are fighting this. You know, they're trying to stop companies like Tesla that want to pretty much take the world into like a new age of everything electric. But they're fighting a losing battle. I'm just being honest. And by the time they pretty much catch on, it'll be too late. Now, these companies are huge, but that doesn't mean that they can't fail. Now, I know a lot of people have heard the term too big to fail, but companies do fail that are big all the time. Charles Schwab, a couple other companies. So let's move on. Riviera Resources, ticker symbol RVRA, selling around $1.80 a share. Has a market cap of $100 and something million. Not big. This is a micro cap pretty much. They have a revenue of $400 million, so that is good, but they're kind of like British Petroleum in the sense that they do not have an earnings per share. They have no earnings per share. They're in the negative. They have no cash flow. They have no profits. Earnings per share is exactly how it sounds. Earnings per share, meaning if you split up all the money that it came in, their net profit, pretty much after you pay out everything, and you divide it amongst all the shares, that's your earnings per share. So they have negative earnings per share of like $6 and something, which is really bad. But the thing that is crazy is the dividend yield. They have a dividend yield of 163%. So like I said, you have $1.80 to buy the stock, and they're paying you $3. Do you see that? That's just crazy. And then if you look at it, if that doesn't scare you away from this stock, maybe this might. Before that, so their last dividend payout, they just started paying their dividends. This will be their second dividend payout. Their first dividend was in the fourth quarter of 2019, and that was only a 40% dividend yield. Now that's still high, that's still pretty high, but it's like that huge jump tells me as an investor that this company is definitely on the verge of either bankruptcy, running out of money, even though they already don't have money, and probably won't be around too long at the rate that they're going and at the size that they are. Now the payout ratio is like negative 43%. Of course, we're gonna say like, okay, that's not that bad compared to like British Petroleum, but that's bad with your dividend yield paying you more for than what the actual stock is selling for. At that rate, you might as well just buy out the company and take it private, in my opinion. But these are definitely red flags when it comes to investing in a dividend company. These are companies that you should want to stay far and far and far away from. And all of this knowledge is easy to find. Even if you don't have, so like let's say you invest with Robinhood, and what I've noticed about Robinhood, they don't show all of this information. It's still easy to find with a simple Google search. You can use Yahoo Finance for free and see the payout ratio and the dividend yield and all of that stuff. So I'm just gonna say it. There is no excuse when it comes to research and not doing research on the company. Do not just read a news article. Don't just follow Robinhood's most bought companies. Like, pick a company that you know, that you're familiar with, that you understand how it works, that you love the business model. Meaning that even if that company takes a dive, as long as the business model don't change, meaning how they make their money, then you can stay in that company. But these are pretty much just some tips that you want to look out for when it comes to like dividend stocks. A couple terms that if you didn't already know, that now you know. You can pretty much factor that into like the evaluation of a company that you're looking at if you're thinking about a dividend stock. But you definitely should give every company it's a thorough look through before you invest in it. Like I mentioned in the beginning of this video, I will have another video coming soon, probably sometime this week. I'm going to take a break from Battle of the Brands for this week to kind of get myself together and do a little bit more research on like my next companies that I want to go a deep dive into. But I will give another video just so I can keep delivering you great content, free content. I want everyone to know these things because it's pretty much simple. I'm not charging you a $5,000 class to pretty much tell you all of this stuff. I'm going to be honest with you, a lot of this stuff when it comes to stock is common sense. It's simple common sense, and it's really just learning the terms, which is very easy. Like another tip, you can pretty much type in Google NASDAQ, which is NASDAQ glossary. And then pretty much what that is exactly how it sounds. A glossary will come up and you can click on each letter and pretty much go through those words, and it pretty much explains everything. So you can click on PE and it'll pretty much have the definition for what a PE is, the ratio, the EBITDA or EBITDA, you know I can't say that word already. Pretty much the enterprise value, something else you need to know when you're looking at companies, the earnings per share, like I said, the dividend yield. It pretty much explains all of that stuff. So if there's anything that you don't know when it comes to like stock and terms and all that stuff, just literally go to NASDAQ glossary or Investopia and pretty much type it in and understand these things. So good luck, get out there, make some fail-safe investments. It's always better to be in the market investing, not actively investing, but just in the market, have some money in the market investing and be on the sideline expecting like a dip or something like that. So good luck. The next video will be sooner than you think, maybe possibly in a couple days, probably tomorrow, I don't even know yet. But I will have video on like building a dividend portfolio, and that's pretty much it. So let's get it, let's do it.